Hello everyone, this is Kevin Zhao. In this chapter, you will learn what a futures contract is, why investors use a futures contracts, and how to trade a futures contracts for both speculation and risk management purposes. On the spot market, people buy and sell certain assets today with the money paid or received instantly. On the futures market, people do different things. They make promises to buy or sell certain assets in the future at the price they agree upon. Most futures contracts traded on futures exchanges. The futures exchanges standardize the quantity and quality of underlying assets as well as the settlement dates. The futures exchanges facilitate the futures contract trades, providing investors a place to improve the price discovery and, more importantly, to manage and share various types of risks. The settlement of futures contracts are guaranteed by a futures clearinghouse. Both commodities and financial assets can be traded as the underlying assets in a given futures contract. For example, commodities are agricultural products such as wheat, corn, soybean, milk, orange, and so on. Metals such as copper, zinc, gold, silver, platinum, and so on, and energy products such as oil and gas. The examples of financial assets are stocks, bonds, stock market indexes, foreign currencies, and so on. Guess what? Even the weather-related measures such as temperature, amount of rainfalls, snowfalls can be made as underlying assets for weather futures contracts. To see the full spectrum of underlying assets available in the futures contracts, please visit website of CME, Chicago Mercantile Exchange. The Futures Clearinghouse helps facilitate an orderly place and keep track of obligations for either buyers or sellers. Since futures contract presents obligations for both buyers and sellers, there are significant risks associated with the potential defaults and liquidity. To settle a position in a futures contract before the settlement date, investors often take an opposite position in the same contract so that obligations in the initial contract are offset completely. Futures contract trading is regulated by CFTC, Commodity Futures Trading Commission in Chicago. Now, let's take a look at some details for futures trading mechanism. At the initiation of the futures contract, both counterparties do not need to exchange the money and the assets. Buyers who take a long position in the contract makes a promise to buy, while the sellers who take a short position promise to sell. Contracts can be settled either deliver assets or offsetting. In the former case, on the settlement date, buyers make payments and the sellers deliver the assets. In the latter case, buyers and sellers settle by taking an opposite position, so they do not need to go through a costly process of good delivery. More than 95% of futures contracts are settled in the latter way. Open interest is the number of existing futures contracts that are not yet settled on the exchange. Due to the potential default risk on a futures contract, when a futures contract is initiated, certain amount of good faith deposit need to be placed for both counterparties to honor their obligations. The good faith deposit is called a margin, which accounts for a small percentage, say 6% of the underlying asset value in the contract. The amount of margin will be adjusted and enforced by the exchange on the daily basis, and this process is so-called mark-to-the-market margin adjustment. How to use the futures? There are two very different ways of using it, either for hedging or for speculation. Hedging is an investment strategy where investors do not aim at generating gains but at eliminating risks. A hedger is an investor who does hedge. Let's say a farmer is going to harvest 1 million bushels of wheat in coming October. His or her concern is potential decline in wheat prices. To protect the price on wheat, the farmer needs to engage in a short position in wheat futures contract. In case of price decline, the losses due to lower wheat price can be compensated by gains in the futures contracts. The combination of the real asset wheat and a short position in wheat futures contract can effectively lock in the wheat price, protecting farmers from any price decline in the wheat. However, in case of wheat price increase, the actual gains from selling wheat at a higher price will also be offset by losses generated in the futures contracts. By the same token, a wheat processor can engage in long position of wheat futures contract to combat the wheat price volatility. In both cases, futures contracts are used for hedging or risk eliminating purposes. Hedging by using futures contracts is not risk-free. The basis risk is the most important concern for most hedgers. Futures can also be used for speculation. If investors predict that the wheat price will increase in the future, they can take a long position in the contract. An investor who predicts wheat price decline should take a short position. Futures contracts provide leverage for speculators so that speculators can use small amount of money to bet on a much larger, say 10 times or even 20 times bigger position. As a cautious note, using futures contracts for speculation is extremely risky due to its high leverage. There are many financial futures contracts available for investors, such as foreign currency futures, stock index futures, and fixed income security futures to manage a variety of financial risks. Foreign currency futures allow investors either to speculate on changing foreign exchange rate or to hedge against the currency risk. Interest rate futures make Treasury securities as the underlying assets. It can be used to manage interest rate risk for U.S. large corporations or financial institutions. The interest rate futures contracts are most popular futures contract on the market due to huge demand for interest rate risk management. Stock index futures offer a great tool for fund manager to manage equity market risk. Sometimes, the price of a certain stock index future can be deviated from the true value of the index. In this case, investors can simultaneously take a long and short position in both futures index and underlying index stock portfolio to exploit the difference at risk-free gains. This strategy is called index arbitrage. Investors who want to speculate on stock market trend can also use stock index futures to maximize their potential gains. Individual stock futures offer investors opportunity to either speculate on individual stock prices or manage individual stock price risk. This is Kevin Zhao. I hope you enjoyed this video, and this is the last chapter of the class. Thank you so very much.